You see price break above the morning high, and your hand moves toward the buy button before you have decided where the trade is wrong. The move is already extending. The candle is larger than usual, and waiting feels more dangerous than entering. That feeling is the first warning. The problem is not simply that you are chasing price. It is that recent movement has changed what you expect to happen next. Speed begins to look like confirmation, and the fear of missing the move quietly replaces the conditions you normally require. That substitution has a market consequence. When you enter after the obvious expansion, your stop may need to sit farther away, while the remaining opportunity may already be smaller. You can be correct about direction and still accept a poor trade. Consider a hypothetical example. Price breaks resistance after several failed attempts, surges quickly, and you buy near the top of the expansion candle. The breakout may continue. It may also retest the level immediately. The important question is not whether the trade wins this time. It is whether you knowingly accepted worse information, worse location, or worse risk because the market created urgency. Some trades should be avoided even when the chart looks attractive. Others become dangerous only because of when you take them, what happened immediately before them, or what you are trying to recover from. Next, examine the specific situations where restraint matters more than prediction, and the observable signs that tell you a trade is asking for risk without offering enough evidence in return. A clean move can become dangerous after it becomes obvious. You may watch price build for 20 minutes, hesitate while the entry is still close to the level that matters, then finally act after the move accelerates. Nothing about the direction has changed. What changed is the price you are paying for the same idea. That difference matters because entry quality determines how much room the market has to prove you wrong before the trade becomes expensive. When you enter late, the logical reference point may remain far behind you. The distance to invalidation grows, while part of the expected move has already happened. A trade that once offered favorable structure can quietly become a poor bargain. The trap is that stronger movement often feels like stronger evidence. Sometimes it is. But evidence and opportunity are not the same thing. By the time uncertainty feels low enough for you to act, the market may already have charged a premium for that comfort. So before entering an extended move, ask a narrower question: am I buying the original setup, or am I buying reassurance? Imagine a hypothetical breakout that offered a reasonable entry near its trigger, then runs sharply before you act. The later price may still rise. But if your downside has expanded while your remaining upside has contracted, continuation alone does not make the decision sound. And there is another reason a trader may suddenly accept a trade he would normally reject. A reason that begins before the new setup even appears. A loss can remain active in your mind long after the position is closed. You take the stop, look at the reduced balance, and almost immediately begin searching for another entry. The chart may be different, the setup may be different, but the purpose of the next trade has changed. You are no longer asking only whether the opportunity deserves risk. Part of you is asking whether it can repair what just happened. That shift is subtle because it often feels productive. You are studying, scanning, looking for a way forward. But urgency changes your standards. Conditions that would have looked weak an hour earlier begin to look acceptable because doing nothing means sitting with the loss. A hypothetical example: you lose on a morning trade, then notice a mediocre setup shortly afterward. On an ordinary day, you would pass. Now you find 3 reasons to enter. The market did not improve. Your need for a result became stronger. That is the danger. The second trade inherits a responsibility no trade should carry. It must not only succeed on its own terms emotionally, it is expected to cancel the first mistake. Because of that burden, neutral price movement feels disappointing and ordinary uncertainty becomes harder to tolerate. Before taking the next position after a loss, remove the previous result from the question. If that earlier trade had never existed, would you still want this one? And sometimes the harder problem begins before the loss is even accepted. When the market has already challenged your original reason for being in the trade, but you remain committed anyway. Sometimes the market does not merely move against you, It removes the reason you entered. Perhaps you bought because price was holding above a level that had repeatedly attracted demand. Then that level breaks, the response you expected never appears, and the market begins behaving differently from the trade you planned. At that moment, the problem is no longer the loss. The problem is whether you are still trading the original idea. This is where judgment can become distorted. Once money is committed, you can always find a new explanation for staying. A temporary shakeout, a false break, one more test. Each explanation may be possible, but possibility is not the same as evidence. A hypothetical example: you enter because buyers repeatedly defend a range low. Price later closes decisively beneath it, and attempts to recover fail. If your reason for holding changes from "buyers are defending this level" to "they might return soon," the position has changed before your account records anything final. The market is allowed to contradict you. Your responsibility is to notice when contradiction becomes meaningful. Ask yourself one hard question: if you had no position right now, would the current evidence make you open this exact trade? If the answer is no, ownership may be influencing a decision that fresh observation would reject. And even when your reasoning remains clear, another variable can quietly interfere with judgment: the amount of exposure you chose before the trade began. A position can be technically reasonable and still be too large for you to manage well. You enter with more exposure than usual, and suddenly every small fluctuation carries weight. A routine pullback feels serious. A few ticks against you demand attention. You begin watching the profit and loss more closely than the market itself. Size changes perception, because money at risk changes the meaning of ordinary movement. The chart may be behaving normally, but your nervous system is not reading it normally. As pressure rises, you become more likely to interfere with a plan that required patience. A hypothetical example: you take a setup you have traded before, but this time with twice your usual exposure. Price moves slightly against you, still well within normal behavior. Nothing important has changed, yet you close the trade early because the temporary loss feels intolerable. The market later resumes in the expected direction. The analysis was not necessarily the failure. The size altered your ability to sit through uncertainty. That is why position size is not only a calculation made before entry. It is also a test of whether you can continue observing clearly after entry. Ask yourself, if this position moves normally against me for a while, will I still be able to follow the evidence? Or will the money force a decision? And there is another kind of trade where the pressure does not come from size at all. It comes from trying to find an opportunity that may not actually be there. Price is moving, candles are forming quickly, and several instruments seem active. That can create the impression that opportunity must be present somewhere. So you begin searching harder, adjusting your interpretation until one chart finally looks tradable. The danger is not activity itself. It is the assumption that movement must contain something you understand well enough to risk money on. Once you decide that you should find a trade, observation can quietly become selection. You stop asking whether your conditions are present and start asking which chart can be made to fit them. A hypothetical example: your approach requires a clear directional structure followed by a specific reaction at a defined area. Instead, price is moving sharply in both directions with no clean structure. You notice one familiar feature and enter anyway. That single feature may be real, but the larger conditions that gave it meaning are missing. This matters because a setup is not a collection of isolated visual clues. Its value comes from the relationship between those clues. Remove enough of that context, and you are no longer taking the same trade. So before acting, describe what is actually present without using the words buy, sell, bullish, or bearish. Can you identify the conditions clearly, or are you already arguing for a position? Sometimes the disciplined decision is not to choose the best looking trade on the screen. It is to recognize that none of them qualify. And even when a setup does qualify, there are moments when risk can change for reasons the chart has not yet revealed. A chart can look orderly right up until new information makes the old price irrelevant. You may see a clean pattern before an earnings release, a central bank decision, or another scheduled announcement. Recent volatility looks contained, nearby levels appear clear, and the trade seems easy to define. But the risk you can see on the chart is not always the risk you are taking. An event can change expectations faster than ordinary trading can adjust. When that happens, price may jump from one level to another with little meaningful trading in between. A stop placed at a reasonable technical level does not guarantee an exit near that price, because the market must have willing participants there for an order to be filled. Consider a hypothetical position entered shortly before a major announcement. You plan to exit if price falls 2 points. The news arrives, expectations change sharply, and the next available transactions occur 5 points lower. Your analysis of direction may have been careful, but your assumption about controllable loss was incomplete. That is the distinction to examine. Ordinary uncertainty develops through price movement you can observe. Event risk can arrive as a sudden change in what the market believes something is worth. Before taking that kind of trade, ask whether your risk estimate depends on prices remaining continuously available. If it does, the chart may be giving you more confidence than the execution can support. And after adverse movement begins, a different danger appears when a trader decides that a lower price is not a warning, but an invitation to commit even more. A falling price can create a dangerous illusion. The trade looks cheaper at the exact moment the evidence may be getting worse. You bought at one level, price moves against you, and now the same position can be added at a lower cost. Your average entry improves. On the screen, that feels like progress. But the market does not care about your average price. It is only showing you what buyers and sellers are willing to do now. This is where averaging can hide the real change. Your exposure increases, while the trade has already moved in the wrong direction. If nothing new has appeared to strengthen the original case, you are committing more capital to weaker information. Consider a hypothetical trade entered at 50. Price falls to 47, and you add because the new average becomes 48.50. That number may look more manageable, but it says nothing about whether the opportunity has improved. The important question is what changed in the market between 50 and 47. Planned scaling is different. If additional entries were defined in advance and new evidence supports them, adding has a reason beyond discomfort. But when the decision appears only after the loss begins, examine the motive carefully. Ask yourself if you had no position at all, would the market at this exact moment justify the larger exposure? And sometimes the pressure to manufacture a trade comes from neither price nor a previous position, but from a number you decided you had to reach before the day was over. A profit target can become dangerous when it stops measuring the day and starts directing your next trade. Suppose you decide you want to make a certain amount before the session ends. You get close, but not quite there. Now every new setup is judged against two things: what the market is offering, and what your account still needs to reach the number. That second pressure did not come from price. Once the target feels unfinished, selectivity can weaken. A setup you would normally ignore begins to look sufficient, because it offers a path to completion. The trade is no longer being chosen entirely for its own quality. It is being assigned a job. Consider a hypothetical day where you are up 800 against a personal goal of $1,000. Late in the session, a marginal opportunity appears. Under ordinary conditions, you would pass, but the missing 200 makes participation feel reasonable. Nothing about the setup improved because your P&L reached 800. The market has no obligation to produce opportunity in proportion to your financial objective. When you demand that it do so, your private target begins competing with public evidence. Before taking that extra trade, ask one question: if your account balance were hidden from you, would this setup still deserve attention? There is another kind of position that survives for the opposite reason. It is not being forced into existence by a target. It simply remains open because nothing dramatic has happened yet. Some positions do not fail by moving sharply against you. They fail by doing almost nothing. You enter because you expect a certain response, follow-through, expansion, renewed demand, or renewed selling pressure. Instead, price stalls. It remains close enough to your entry that the trade does not look clearly wrong, so you keep waiting. But time can carry information. If a setup depends on momentum appearing soon, then the absence of that momentum matters. The longer the expected behavior fails to appear, the more you have to ask whether the market is confirming your idea at all. Consider a hypothetical breakout trade. Price clears resistance, you enter, and then it spends the next hour drifting around the breakout level without attracting further buying. The trade has not necessarily reached a traditional invalidation point, yet the behavior you expected has failed to develop. That creates a different kind of cost. Your capital remains committed, your attention remains tied to the position, and you continue granting time to an idea that is producing less evidence than expected. The question is not whether every slow trade should be abandoned. It is whether speed, follow-through, or timely response was part of the original expectation. If it was, then delay is not neutral. Before continuing to hold, ask, if this exact lack of response had been visible before entry, would you have taken the trade? And sometimes a trader overlooks weakening evidence for another reason entirely. The story has become so convincing that failure no longer feels like a serious possibility. The most dangerous trade may be the one that feels too obvious to question. You have several reasons supporting the same direction. The chart agrees with the story. Other traders seem to see it too. Each new piece of confirmation reduces your sense of uncertainty until the possibility of being wrong begins to feel remote. That is when confidence can stop helping and start narrowing your attention. Once you expect one outcome strongly enough, contradictory evidence becomes easier to dismiss. You do not necessarily ignore the market on purpose. You simply stop searching as hard for information that would challenge the trade. Consider a hypothetical setup where price, broader sentiment, and recent momentum all point higher. You enter believing the case is unusually strong. Then buyers fail to respond where you expected them to. If your first reaction is to explain away that weakness because everything else still sounds convincing, certainty has begun controlling the evidence instead of evidence controlling certainty. A strong thesis does not remove uncertainty. It only tells you why one outcome currently appears more plausible than another. The moment you treat probability as inevitability, you become less prepared for information that does not fit your view. Before entering, force one uncomfortable question. What specific observation would make me decide not to take this trade? If you cannot answer that clearly, the problem may not be the setup. It may be that conviction has become too complete, and once a trade does move in your favor, confidence can give way to a very different pressure. The fear of watching an open profit disappear. A profitable trade can become harder to hold after the gain starts to feel like money you already own. At first, you accept normal movement because the position is still proving itself. Then price moves well in your favor. Your account shows a larger number, and without noticing it, that temporary peak becomes a new reference point. A pullback no longer feels like ordinary fluctuation. It feels like something is being taken away. That change in perception can alter your decisions, even when the market has not changed enough to justify them. You begin protecting the highest unrealized profit instead of evaluating whether the trade is still behaving as expected. Because the discomfort of giving back gains is immediate, exiting early can feel disciplined, even when it is mainly emotional relief. Consider a hypothetical position that moves strongly in your favor, then gives back part of the advance during a routine pause. The structure remains intact, but you close because watching the profit shrink feels unbearable. The exit may still work out. That does not mean the reasoning was sound. The useful question is not, how much of this profit can I save? It is, what has the market actually done that changes the case for staying? Open profit is not the same as secured profit, and treating the two as identical can make normal movement feel threatening. But there is another way risk can become larger without appearing obvious on any single chart. Several separate trades can quietly become one concentrated position. Several trades can look independent on your screen while depending on the same market force underneath. You may hold 3 different stocks, perhaps even from different industries, and think the risk is spread because each chart has its own setup. But if all 3 tend to respond to the same index, interest, rate move, currency shift, or change in risk appetite, one event can move them together. That is where the illusion appears. You count positions, but the market counts exposure. Three separate entries do not create three separate ideas if the same condition must remain favorable for all of them to work. Consider a hypothetical case: you buy a semiconductor stock, a cloud company, and a growth ETF because each chart qualifies on its own. Then bond yields rise sharply and all three fall at once. None of the individual trades looked unusually aggressive, yet the combined position carried more dependence on the same outcome than you recognized. The practical question is not simply, how many trades am I holding? It is, what common force could hurt all of them at the same time? Correlation can remain quiet until the market is under pressure. That is why apparent diversification can disappear precisely when you expected it to protect you. And before any position deserves a place in that risk, there is a more basic question to answer. Do you know, before entering, what evidence would tell you the trade no longer belongs there? A trade is incomplete if you know why you want to enter but cannot say what would make the idea wrong. Before money is committed, the attractive side of the trade naturally gets more attention. You see the pattern, the possible move, the reason price might continue. But if there is no clear condition that would contradict that view, every adverse development can later be explained away. That matters because uncertainty becomes harder to judge once you are involved. Without a defined point of failure in the reasoning, you are not testing a thesis. You are simply watching price while hoping your preferred scenario remains possible. Consider a hypothetical setup based on support holding after a pullback. Before entering, you should be able to identify what holding actually means. If price can break the level, remain below it, fail to recover, and you still have no reason to reconsider the idea, then support was never truly part of the thesis. It was only part of the entry story. The discipline comes before the order. Ask what must remain true for this trade to deserve capital, and what observable behavior would make you refuse it entirely. If you cannot define that boundary while you are still neutral, you may not find it easily once the position belongs to you. And even a trade with clear logic can hide another problem. The price you see on the chart may not be the price you can actually trade. A chart can show a perfect entry and still hide a poor trade. You see price touch your level, the pattern is clean, and the distance to your planned exit looks reasonable. But when you try to trade it, the spread is wide, the available size is thin, and the actual fill comes at a worse price than the chart suggested. That difference is not cosmetic. It changes the trade itself. If you pay more to enter and receive less to exit, the margin that made the setup attractive begins to disappear. A strategy built on precise levels becomes unreliable when the market cannot consistently transact near those levels. Consider a hypothetical stock trading around $20. The chart suggests an entry at $20 with a planned exit below 1970. But the best available offer is $20.12 and only a small amount is available there. If you need to sell quickly later, buyers may also be far below the displayed price. What looked like 30 cents of planned risk can become something materially different in practice. So before judging a setup, look beyond the candles. Ask whether the market can actually absorb your intended entry and exit without changing the economics of the trade. A price on a screen is only useful if you can realistically transact near it, and sometimes the weakness is not in the market you chose, but in the fact that the conviction behind the trade was never really yours. A trade becomes fragile when the confidence behind it belongs to someone else. You hear a convincing case from a trader you respect. The reasoning sounds clear, the setup looks plausible, and you enter. But once price begins to move, a problem appears. You know the conclusion, yet you do not fully understand which evidence was carrying the argument. That matters because markets rarely move in a straight line. When conditions change, you must decide whether the change is harmless or important. If the original reasoning was borrowed, you may have no reliable way to judge that. So you start looking back to the source for reassurance instead of reading the market in front of you. Consider a hypothetical trade based on someone else's bullish thesis. Price weakens after entry. You do not know whether that weakness damages the idea, because you never define the idea yourself. Now the position cannot be managed independently. Your capital is exposed, but the decision-making authority remains somewhere else. The useful test comes before entry. If the person who gave you the idea disappeared for a week, could you explain why the trade still deserves to exist? Borrowed analysis is not automatically poor analysis. The danger begins when understanding is replaced by trust. And even when the reasoning is completely your own, a familiar setup can still fail for a different reason. The market environment that once supported it may no longer be present. A setup can remain familiar long after the market that made it effective has changed. You recognize the pattern because you have seen it work before. The entry looks the same. The structure appears similar. But markets do not reward shapes in isolation. They reward patterns only when the surrounding conditions support the behavior you expect from them. A breakout that performs well in a persistent trend may repeatedly fail when the market becomes rotational. A pullback strategy built for calm conditions may behave very differently when volatility expands. The pattern has not necessarily changed. The environment around it has. Consider a hypothetical setup that produced clean continuation during several weeks of steady directional movement. Then the market begins reversing sharply, breaking levels in both directions, and rejecting follow-through. You continue taking the same setup because it still appears on the chart. What changed was not your ability to recognize it. What changed was what tends to happen after it appears. That distinction matters. Familiarity can make a setup feel permanent, but an edge often depends on conditions that are temporary. Before entering, ask what environment this trade was designed to exploit. Is that environment still observable now, or are you trusting the pattern because it worked under different conditions? A few losses do not automatically prove that a regime has changed, but repeated changes in market behavior deserve attention. And sometimes adaptation fails for another reason entirely. Recent success convinces you that your judgment has become better than it really is. A large win can make the next trade feel safer than it really is. You close a position for a strong gain, and something subtle changes. The next setup does not have to work as hard to earn your approval. You may enter faster, excuse a weaker condition, or take a trade you would normally leave alone. The reason is simple. Recent success changes how risk feels. Profit creates a sense of cushion, and confidence rises with it. But the market has not become more forgiving because your last decision worked. The next trade still begins with uncertainty. Consider a hypothetical trader who has just had an unusually profitable morning. An average setup appears an hour later. On a normal day, he would reject it. Today, he takes it because he feels in rhythm and because part of the recent gain seems available to risk. The setup did not improve. His resistance to taking it weakened. That is the distinction worth watching. Confidence can improve execution when it removes hesitation, but it becomes dangerous when it starts lowering the price of admission for a trade. After a strong win, ask whether your standards are exactly where they were before the profit appeared. Would you take this position with the same conviction if the morning had been completely uneventful? Success can make patience feel unnecessary, and that impatience can produce the next mistake, entering before the market has actually completed the condition you were waiting for. A trade can look attractive precisely because the market has not confirmed it yet. You see the setup beginning to form. One more break, one more close, one more response would complete the picture. But entering now offers a better price, so you act before that condition arrives. The problem is that you have replaced evidence with expectation. You are no longer trading what the market has done. You are trading what you believe it is about to do. The earlier entry may improve the price, but it does so by asking you to accept more uncertainty. Consider a hypothetical breakout setup. Your plan requires price to clear a defined level and hold above it. Instead, you buy just beneath that level because momentum appears strong and you expect the break to follow. Price reaches resistance, fails and reverses. The trade did not fail after confirmation. Confirmation never happened. That difference matters. Waiting is not simply about being cautious. Sometimes the event you are waiting for is the information that separates a valid setup from an attractive guess. Before entering early, ask what exactly you are being paid for by taking the extra uncertainty. Is the slightly better price worth losing the evidence your plan required? Anticipation can feel intelligent because it puts you ahead of the crowd. But being early is useful only when early entry is actually part of the method, and price itself can create another illusion, especially when an old high or former value makes the current market look cheaper than it truly is. A lower price can look attractive for no better reason than the market used to trade much higher. You remember the old level. Maybe the stock was near 100 a few weeks ago and now trades at 70. The decline itself creates the feeling of a discount. But lower than before is not the same as cheap now. The old price becomes an anchor. Once your mind accepts it as the reference point, every drop is measured against where the market was rather than against what current conditions justify.